Good morning, ladies and gentlemen, and welcome to the Balanced Perspective on this, the first day of December 2020. The Balanced Perspective is a webinar that is 15 minutes long, that is hosted in conjunction with Iain Power, CIO of Truffle Asset Management. And the idea is to discuss the main themes and topics of the day as it relates to both South Africa as well as global markets. Welcome, Iain.
Morning, Sean, and welcome to everyone on the call.
Thank you. We have about 500 odd people on the call today, so you have a few people that are interested in what you have to say. And I think just to do recap, because I don't want to use more of the 15 minutes than I have to, today the questions that we really would like to pose or consider is that of South Africa and the South African markets. We've obviously seen a very interesting November with a bit of an SA Inc rally and a stronger rand. And I certainly know that much of the time you've always been low SA-facing equities, as you call it. And then, of course, the bigger second question is global emerging markets and how you view that going into 2021.
Okay, well, thanks, Sean. Well, both those questions are interlinked insofar as what we've seen from a November perspective. But I think if one just takes a step back and from a truffle point of view, I think our last feedback to our clients really just saying that we thought a potential vaccine could catalyze a rotation into some of the bombed out EM markets, and specifically also, SA Inc. I think where we've seen many of those names benefit in the month of November has certainly come to pass. So I think from a bigger picture point of view, the planets are starting to align insofar as EM recovery and potentially EM looking like it is going to have a better 2021, particularly vis-a-vis some of those defensive markets and assets or those dollar-based growth assets. And I think the basis for our view is largely predicated on the fact that we do have vaccines that are coming online where the efficacy or the effectiveness of the vaccine looks as like it is pretty high. So the big question is the speed of manufacture and distribution of these vaccines, which will provide a solid runway for the level of economic activity around the world, as particularly in some of the countries that have been heavily hit, where tourism and services is a big part of the economy, to get back to pre-COVID levels. And what one is starting to see is investors starting to position for that by selling and potentially taking profits in some of the high growth tech and defensive type assets and switching them into more economically sensitive assets. And this is really what we've been positioning the fund for over the last couple of months. So I think that backdrop seems to be largely intact, and I think the runway to a better 2021 in terms of economic activity looks more certain. Yes, there are always risks. US fiscal stimulus, is there going to be enough? Will the Republicans and Democrats agree? These are all factors which could introduce short-term noise, but I think by and large, the recovery looks like it's on track and investors are starting to position for that. And I think all the classic signs that one would look for in terms of that trade looks as though they are really being reflected in markets, and that would be things like weaker dollar. As a consequence, we've seen rand as well as other EMFX be a little bit stronger, notwithstanding our own country-specific issues. And then also those economically sensitive stocks, which typically lead the economic recovery, being cyclicals, have had a very good November. Along with some bounces in some of the bombed out EM geography. So I think, from a truffle point of view, this is something that we've been positioning for. And I think, the fund has had a pretty good November, and I think we're up almost double digits, 10%. And I think the prospects certainly for EM are looking brighter from a 2021 perspective. Now, the question is, as Sean said, what does this mean for SA Inc? Now, SA Inc., as many of you know, we've been concerned about for the last couple of years because of the structural issues that we're dealing with. Many of those which haven't gone away, although there have been some green shoots on the horizon, which some of you may have seen from our feedback to you sort of six odd weeks ago. And I think a combination of the vaccine trade, where people are getting more confident about EM, together with some of the country-specific news, which I think has been slightly more positive insofar as power production being allowed to be acquired in terms of RPPs, municipalities being able to source their own power, spectrum being announced in terms of that auction to be concluded by March. And then we've obviously seen some corruption being sentenced and prosecuted, which is what we're all waiting for. So I think those are slightly positive. The big elephant in the room is obviously still the fiscal issue, where government is spending way too much vis-a-vis what they can afford. And I think that really creates the dilemma from an SA Inc. point of view, where optically you've had a lot of bombed out assets which have looked cheap, but we need to see a sustained earnings recovery to drive that on a sustainable basis. And I think the problem in not dealing with the fiscal issues means that perhaps the window of opportunity for SA-focused assets to do well is probably going to be shorter than some of the other more sustainable EM geographies. So, I think we've seen a sort of a bounce in the month of November. And if you just look at some of the month-to-date returns on some of the SA Inc. names, lots of these stocks are up 20-30%. And I think that's good. And that's obviously coming from very sold down levels. But the question is, to have a sustained outperformance from SA Inc., we're going to have to see meaningful earnings outperformance from many of these shares. So I think from an SA Inc. perspective, we upweighted some of those higher quality SA Inc. names. Many of you who have followed our presentations would have seen some of the shares that we were advocating buying, some of the financials, some of the retailers, Cashbuild, Italtile, Woolies, Pepkor. Lots of these shares are up meaningfully in the month of November. And some of those bombed out property names, specifically Hyprop, which we've been talking about to our clients for quite some time, is up about 50%. So I think we've seen quite a nice recovery in some of these names. Does it mean that we have changed our view in terms of our concerns around the SA structural issues? No, we are still very concerned about SA's fiscal position, but SA is now getting the benefit of money that is starting to move into emerging markets, because throughout the whole of 2020 you effectively have had a huge exit, circa $90 billion of capital that's gone out of emerging markets, and that money is now starting to come back. So even though South Africa is not one of the preferred destinations from an EM perspective, it is still going to benefit when money goes into these ETFs. So yes, investors might be underweight SA, but to the extent that SA is still in the index, we are going to receive flows. So I think that probably bodes well for sort of a decent Q1, Q2, at least from an SA Inc. point of view. But to see a meaningfully and sustained recovery relative to the offshore earners, I think we're going to need to see a very strong earnings recovery, notwithstanding the low COVID base. And there is where we would still have some questions. So from a portfolio point of view, what did we do? Well, given the fact that we were largely more positive on EMs and positioning for a risk on trade, we upweighted our offshore equity, but particularly focusing on those emerging markets outside of SA, which have also done quite nicely. So I think we've been playing it through a barbell approach, where we've got the heavy weightings in some of our resource offshore earners. We reduced the likes of our NASPASs and our BTIs, all of which have underperformed many of these bombed out names, and then upweighted some of the offshore EM shares at the expense of DM. And I think that's worked quite nicely for the portfolio, and we would expect that this trade will continue, given that EM valuations relative to DM are fairly cheap, and that growth prospects for the world are improving. and investors will continue to trade, we think, and sell stocks which are potentially high growth names which have done well, and those shares which are potentially susceptible to higher long bond rates, which we think is in the offing in next year as the recovery and the vaccination program rolls out. So I think that probably summarizes our view at the moment. And then perhaps just also to say, before I hand back to Sean, all emerging markets are not equal. Some are better than others. And I think, SA, likes of Brazil, Turkey, perhaps sit in the category of least loved in terms of their own fiscal and structural issues. But, the likes of Mexico, a lot of the Asian EMs, Colombia, obviously in much better position. So I think that's, from a truffle point of view, we've been trying to take advantage of these cheaper valuations in some of the emerging markets where you don't have the same structural risks that we do from an SA context. And that's not to say that it can't change, but certainly, we would want to see significant fiscal cutbacks in terms of some of the promises that we've seen in terms of the October budget, particularly with the government bloated wage bill, which will then make us sustainable. So with that, I'd like to hand back to Sean, perhaps for some questions or just reflecting on our position.
Thank you, Iain. I think one of the questions that have come up, which they always do, in the past, you've spoken about your concerns re the irrational exuberance of investors in the big tech stocks. You spoke about Tesla before. Just wanted to get a sense from you, and it is the flip side of obviously of GEM, what your thoughts are going into next year, specifically the large tech stocks.
Yeah. I think it's a very, very important point you raise, because I think, investors have done very well from having exposures to many of the secular growth names. And we're certainly not saying that the market share gains or the earnings growth of these businesses is going to stall. That's definitely not what we're saying. We just think that the ratings or the prices, the multiples that investors are paying for many of these shares have reached values and valuations which are extreme, to say the least. And I think the risk for investors holding these shares is if you get a continued rise in the 10-year US Treasury, or the discount rate, which is used to discount these cash flows, you get a disproportionately negative impact on these very long duration growth equities. And I think, if US long bonds were sort of 1.5% this time next year, or 1.7%, I think you're going to see significantly lower ratings in some of these high growth companies, to the extent that a lot of that value is way out in the perpetuity value of the DCF, as opposed to some of the value economically cyclical companies, where the impact is much, much less. So I think that would be a rotation risk that, investors, if you are holding portfolios which have got high concentrations of those high growth, high multiple assets, perhaps now would be the time to be looking to take some profits and switch it into, better valuations of some economically cyclical names, which we think are going to benefit, and certainly from an earnings point of view are likely to outperform some of those big heavy tech companies.
Thank you, Iain. That brings us to 10:15. I'm not going to keep you in line any longer. Thank you for what you have done for the portfolio this year, and you've managed to look out for the landmines and the issues. I think the only person that will not think it's the end of the year is Donald Trump, but we are at the end of the year, and we look forward to speaking to you again in January. Thank you, Iain.
Thanks, Sean, and thanks to everyone on the call, and have a safe and happy rest over the holidays.